What is EBITDA? EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's a financial metric that is commonly used to assess a company's profitability and operating performance. Now, you might be wondering, why is EBITDA important and why do we exclude those specific items? Let me explain. By focusing on EBITDA, we can get a clearer picture of a company's operational efficiency and profitability, before considering certain financial factors. Let's break down what each part of the acronym represents. Earnings. This refers to a company's net income or profit after deducting all expenses, including the cost of goods sold, operating expenses, and non-operating items. Before. It's important to note that EBITDA looks at earnings before considering certain items, so we can get a better understanding of the core business performance. Interest. Interest expenses arise from borrowing money, such as loans or bonds. By excluding interest, we can focus solely on the company's operating performance, regardless of its financing decisions. Taxes. Tax expenses can vary depending on different jurisdictions and tax laws. By excluding taxes, we can analyze the company's profitability without the impact of tax rates and policies. Depreciation. Depreciation is the gradual reduction in the value of tangible assets over time. It's a non-cash expense that reflects the wear and tear or obsolescence of assets like buildings, machinery, or vehicles. By excluding depreciation, we can focus on the company's operational performance without considering the accounting treatment of these assets. Amortization. Amortization is similar to depreciation, but applies to intangible assets like patents, copyrights, or goodwill. By excluding amortization, we can assess the company's performance without the influence of non-cash expenses related to intangible assets. By adding back interest, taxes, depreciation, and amortization to the earnings, we arrive at EBITDA. This metric helps investors, analysts, and businesses evaluate and compare the operating performance of different companies, especially those in capital-intensive industries where depreciation and amortization expenses can significantly affect the bottom line. However, it's important to note that EBITDA has its limitations and should not be the sole metric used to evaluate a company. It's always advisable to consider other financial factors, such as cash flow, net income, and industry-specific metrics, to get a comprehensive understanding of a company's financial health. So, in a nutshell, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's a metric that helps assess a company's profitability and operating performance by excluding specific financial factors. While it provides valuable insights, it should be used in conjunction with other financial metrics to get a complete picture of a company's financial health.